A strong number of economists believe that the Fed is going to start the rate cuts in June, which is incredibly bullish for real estate investment trusts. The reason for this, when we take a look at historic data, on average, listed REITs have historically outperformed the broader equities following the rate hikes. So we can see the return 6 months before any initial rate hikes. REITs are underperforming 3.3%. However, at the end of hikes, we see a massive difference between the US equities versus US REITs. So we are expecting in this year, around June, July time, for the REIT industry to completely boom, giving a lot better market returns than US equities. Now, in today's episode, we're going to take a look at 3 REITs to buy now. We're also going to cover 1 REIT to sell with a dividend cut impending in 2024. As always, we'll look at the historical performance of each company. We'll look at their dividend safety. We're going to look at their financial metrics. And we will run them through the valuation model, getting to our intrinsic value as well as our acceptable buy price given the margin of safety, and look towards Wall Street forecasts over the next 12 months. And today, 2 of the REITs we will be covering are new REITs that we haven't looked before on the channel. And at the end of the episode, if you are interested, we're going to talk about an ETF for real estate for those that don't want to be cherry picking any REITs individually and want to spread their risk. So let's jump into the episode today. The first REIT to buy now is Essential Properties Realty Trust, ticker symbol EPRT. Now, it is up 3.3% over the last 12 months. It is trading in the mid to upper end of the 52-week range with a forward yield of 4.57% and a P to FFO of 13.36. Now, if this is one you have been holding over the last 5 years, you would be up 46.63%. Bear in mind, though, that doesn't include those dividends reinvested. So in terms of the dividend safety, it sits at 60, borderline safe. We'll touch upon that as well. 4.14 billion. It is a mid-cap company in respect of their market cap. In terms of dividend growth, we can see over the last full year 4%, which is the minimum I like to see on the channel just to keep up in line with inflation. Over the last 5 years, however, very strong double-digit increases year on year. 21% looking very nice, and they have increased those dividends for the last 5 years consecutively. Now, in terms of dividend yield theory, as always, for those that are new, it shows a company is undervalued when the current yield sits above the 5-year average. Right now, we have a sign of undervaluation / reasonable valuation, 4.55 versus 4.45. But we do note here the forward P to FFO is sitting lower than the 5-year average of 14.4 versus 16.3. So do bear in mind that we're not looking at any of these models in isolation, and we can see here that the real estate sector P to FFO is slightly lower at 13.7. Now, in terms of the payout, as always with REITs, we do draw your attention to the adjusted FFO funds from operation. Free cash flow, a lot more volatile. What we're aiming for is below 90% year on year, and that's exactly what we see from this REIT. In fact, 2023 at 68% is very positive, very low. 2024, in fact, is expected to go even lower, so I would like to see a nice double-digit dividend increase in their next installment. On the adjusted funds from operation, nice growth going from 78 cents, more than doubling to 165 in 2023, and expected to go higher to 174 in 2024. What we also like to see is that adjusted funds per share growth percentage-wise, very strong percentages over the last few years. 2024, even at that 5% level, is still looking pretty attractive. Sales growth, as always, for REITs, steady moderate growth, 5 to 10%, and we can see double-digit growth to their top line every single year, whilst also increasing their AFFO per share, which is very important, and that is something that they have delivered year on year. Sales then numerically, 21 million in 2016, 360 million in 2023, looking very strong. Again, with REITs, we always mention this, but for those that are new, they do essentially issue shares, dilute your position over the longer term. It is normal, and this is because they retain little of that internally generated cash flow after paying dividends, but always make sure that whilst they are increasing those shares, that they are also delivering a lot of growth on the AFFO. But again, also important to note, different REITs will dilute your position at a different rate. ROIC, now we want to see a minimum of 3 to 5%. What's nice for this company is that in 2023 they hit 5%, and in fact from 2016 this metric has been improving, so this is positive in my opinion. It does give me faith in management when I'm looking at this and their ability to effectively allocate their capital. On top of that, operating margin is looking very strong in 2023 at 62%. In fact, even in 2016, 34% was pretty decent, so they are improving their operational efficiency year on year, increasing that operating margin, going higher and higher. Always very, very strong as an investor to know. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, as always, relates and correlates in fact to that dividend safety as well as the balance sheet strength. Now, it has been decreasing year on year. We want to see a maximum of 5.5, ideally much lower. 5.1 in 2023, expected to go significantly lower in 2024 to 4.15. Gives me faith that there is no issue with that dividend safety, along with the fairly low AFFO payout ratio as well. So overall, looking pretty solid. So let's jump into the valuation of this company. As always, if you do enjoy the content and value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on this channel, we do run through every single model. Today's episode, let's jump straight into the final calculation and we get to an intrinsic value of just under $30. Now, with a price of $25 in today's market, we start off with that margin of safety of 10%. Bear in mind now we use 10% if we believe it meets 3 criteria, which is always important to remember: a wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy up to around $27. At 15%, we can see at $25.46, and at 20%, it isn't quite there yet. So for today's episode of EPRT, we see around 15 to 20% margin of safety. In terms of Wall Street and their expectations, well, they have a price target of $28 over the next 12 months. They see upside of 12%, which they do in fact indicate it as a buy. As always though, do let us know your thoughts as we do run through these REITs. The next REIT we are taking a look at is Big Yellow Group. Now, this is a self-storage REIT, down 5% over the last year. Over the last 10 years, however, up 53%. Again, doesn't include dividends reinvested, and we see their all-time highs, $23 at the beginning of 2022. They're trading in the midpoint of the 52-week range with a yield over 4%, and they have a trailing 12-month PE at around 11. Now, in terms of these metrics, let's dive in and take a look. We can see a very small market cap, so they are a mid-cap company. They have in fact been paying some very, very large increases to the dividend, 8% over the last full year, 8% on average over the last 5 years, and on average over the last 20 years, strong double-digit 21%. Do bear in mind this is a UK self-storage, so they do pay out in GBP. And when we take a look at those metrics, well, on the earnings payout, looking below 80 to 85%, so looking very solid as it is consistently giving these same metrics. 79% in 2023, looking fairly positive. On the earnings per share, again, been increasing year on year, going from 21 cents in 2014 to more than doubling, in fact, nearly tripling to 2023, although we do see the expectation that it is expected to be around the same number in 2024's annual report. In terms of the sales growth, mid-digits year on year, not the greatest, but it is pretty consistent. In 2023, 8% does look very nice. 2022, they did have a stellar year, up 26%. In terms of the total sales numerically then, 73 billion in 2014, more than double 189 in 2023. On the positive, they don't dilute your position as much as other REITs, increasing it from around 140 million in 2014 to 184. In terms of the ROIC, pretty consistent around the upper end of the target of our 3 to 5%, 4% though over the last 2 years. In terms of the operating margin, now they have increased it over the longer term, but even in the mid to low 60s year on year is a very, very strong metric for REITs and the self-storage industry as a whole. On top of that, the net debt to EBITDA has been climbing down consistently. Remember, we want to see below 5.5, 4.08 in 2023, 3.71 in 2024 expected. So this is a very strong REIT when we look at their dividend safety as well as that balance sheet strength. Now, in terms of the evaluation, this is one that essentially does look to be a very strong buy according to Wall Street analysts. We can see the intrinsic value for today's episode is the average of these two models, coming to $16.35. Margin of safety then, 10%, a buy up to $14.71, 15% up to $13.90, and at 20%, $13.08. So it is pretty much in between a 15 to 20% margin of safety at the current price in today's market. What about Wall Street? Well, they see some very strong upside. They believe this to be a very, very strong buy now. 25% upside with a price target of $17 over the next 12 months. making this one of the best essential self-storage REITs to buy now when you do compare it to the others out there like Public Storage, as well as Extra Space Storage and Stag Industrial. Now, before we move to the next REIT to buy now, we just want to let you know we have released our latest free weekly article. If you want to gain access to this or any other of the articles we have produced, all completely free, do click on that pinned comment below to sign up and gain instant access. The next REIT that we do believe is a strong buy is Agree Realty Corporation. Now, this has been hammered like the majority of the REIT industry, down 17% over the last year. Over the last 10 years, however, we see it up around 88%, and we do know a lot of insider buying by management for shares of this company. It is trading in the mid to lower end of the 52-week range with a yield of over 5% and a P to FFO forward-looking of 14.16. Dividend safety score 70. It does look to be safe, just under 6 billion. It is a mid-cap company. In terms of those recessionary metrics, well, unfortunately, they cut the dividend during the last recession. They had about average growth of negative 14%, but they also trailed the S&P negative 67 versus that S&P's negative 55. Dividend growth, probably the poorest increase they have had in some time at 1.6% below inflation, although on average over the last 5 years it is increasing at 6%, although when we do look at over the last 20, unfortunately it is below that 4% mark. They have also been increasing those dividends for the last 11 years consecutively. In terms of dividend yield theory though, we do have a double massive sign of undervaluation, a yield of 5.09 above that 5-year average, and the forward P to FFO 14.2 significantly below the 5-year rolling. When we do compare it to the real estate sector P to FFO though, it is slightly higher. In terms of the adjusted funds from operation payout, remember below 90%, and with ADC consistently below that, in fact far below 74% in 2023, expected to go even lower in 2024, so no worries with that dividend safety based on this information. On top of that, with ADC you get continual increases to their adjusted funds from operation year on year. 2024 expect to be more of the same with an increase to $4.10. In terms of the growth per share, a little bit inconsistent, but nonetheless, 4% target in 2024 is still very positive. And we can see over the last 10 years, they have had some very high single-digit increases year on year. In terms of sales growth, well, 5 to 10%, they blow that away. Strong double-digit growth every single year. More recently, though, 25%, which is very nice as an investor. As we can see, what that does to their total sales takes them from 54 billion to 537, essentially 10 timesing their top line over the period. Shares outstanding, nothing much to say other than this is one of the companies similar to Realty Income, similar to Vici Properties, that does dilute your position at a very rapid rate compared to others. The things you want to be looking out for when companies do dilute your position is that ensure they are still increasing their adjusted funds from operation per share. Then that isn't a massive worry, but very important to keep an eye on that. In terms of ROIC, over the last 4 years, it has been at the lower end of what we like to see. Not a red flag indicator, something just to keep an eye on. Ideally, we would like to see it back at the 5% that we saw from 2014 to 2016. Operating margin, now it does look like it is decreasing over the last 10 years. Again, not ideal, not the end of the world, just keep an eye, but still 48% is still very strong for this real estate investment trust. In terms of the net debt to EBITDA, pretty much bang on the maximum we want to see at 5.55. Expected to go lower to 4.7 in 2024, so that is a positive sign. We are seeing a lot of that with these REITs that we have been analysing, so lots of positivity entering into 2024 and 2025 with their annual accounts. I do expect a lot of these to rebound significantly. Now, in terms of the valuation, and bear in mind, you can grab a copy of this model if you want to run your own companies to get to your own intrinsic value and acceptable buy price by clicking on that pinned comment below and grabbing a copy now. Now, in terms of margin of safety, 10% at buy up to $60.20, 15%. It isn't too far off, but it isn't quite there yet. You're looking around that $57 mark, $1 shy. But again, remember, you can't time the market. Always, it's time in the market, not timing. So we have today a 10 to 15% margin of safety level for ADC. What about Wall Street? Well, they see this as another very strong buy now. They have a price target of $68 with upside targeting 17%. As always, let us know your thoughts as we do go along these REITs. Now, the next REIT is one that we are looking to sell. It isn't a REIT to buy now. It's Omega Healthcare Investors. Now, this is up around 12% over the last year. Over the last 10 years, down 6% as we can see. All-time highs sitting around $45. It has touched it a few times over the last 10 years. It is in the midpoint of the 52-week range with a yield of just under 9% and a P to FFO of just over 11. Now, in terms of dividend safety, we have a score of 40, unsafe, market cap $7.5 billion, a mid-cap company. In terms of those recessionary metrics, while they maintained the dividend, they didn't increase it, but they didn't cut it. They had above average growth, and they also significantly outperformed the S&P -21 versus that -55. Now, they haven't increased the dividend, as we can see, since 2019, but over the last 20 years, on average, if you were a holder, you would be up on that dividend at 11% rate annually. In terms of dividend increases, though, they have been paying dividends for the last 20 years without a reduction. What about dividend yield theory? Well, we can see here now it isn't too far off the 5-year average. So again, you could argue based on this model alone in isolation, reasonable valuation / slight undervaluation. On the forward P to FFO, we see it pretty similar against the 5-year rolling average. So again, you could argue reasonable valuation. It does currently sit much lower than the real estate sector P to AFFO. Now, in terms of the essential payout ratio, what we can see here is, and this is one of the reasons why we do believe that it is a sell, that dividend cut does look extremely likely. And even if it's not, just something to bear in mind, they are paying out a significant, in fact, more than 100% of their adjusted funds from operations as dividends. 102%. This is a red flag indicator, and we can see 2024 expected more of the same. We want to see a maximum of 80% in the senior living REITs. So again, in my opinion, given we've seen this since 2017, this is a big red flag indicator. In terms of the adjusted funds from operation per share, another red flag indicator. It has barely moved if you looked at over the last 10 years. Ups and downs, very inconsistent. 2024 expected very minimal movement. And when we look at this percentage-wise, we can see over the last 10 years, 5 years, they've had negative adjusted funds from operation per share growth. And when we look at the sales growth year on year, negative 17% in 2022, 8% in 2023. Very inconsistent when we start to go back year on year. But numerically speaking, though, if you were to look from 2014 to 2023, they have nearly doubled their top line. They also dilute your position as well, increasing shares outstanding from 127 million to 250. In terms of the ROIC, around the 3 to 5%. We do get some years of 6%, notably in the more recent year. So not the worst looking strictly at this metric. But remember, when you do analyze a company, you shouldn't solely fixate on any one metric, and you should conclude based on all the information you have. Operating margin, where we see operational inefficiency with the margin decreasing from 69% to 51%. So something to be on your radar. But as I mentioned, 50% is still fairly strong as margins go. Then when we take a look at the net debt to EBITDA, not something you want to see, especially when the senior living REIT's maximum expectation is 4.5. We see over the last 10 years, every single year, it has been above that. The positive to note from here is that it is expected to come down in 2024, but still above 4.5. And when you include that and couple it with the fact that they are paying out over 100% on the AFFO payout, this doesn't look like a sustainable model. Now, in terms of the valuation, this is quite important. And also remember, it's going to be important when we take a look at the margin of safety and Wall Street's price. This intrinsic value is the average of these two models, coming to $33. Now, current price is around $31 or just under, and that margin of safety, 10%. We can see it isn't quite a buy yet based on this model alone. 5 to 10% is what you're looking at right now, but do bear in mind all of the other factors that we saw. There are a lot of better REITs out there, so in my opinion, this is a REIT to sell. The other three are much better in terms of long-term growth and just the metrics purely on the historical data. And when you couple that with the financial outlook, they look like a lot better of a choice. Now, in terms of Wall Street and their forecast for this company today, they are expecting over the next 12 months to have a negative 25% drop to $23. Probably the worst forecast we have analyzed on this channel for any company, including REITs and others. 23.14 over the 12-year period. So again, whilst I do say bear Wall Street forecast in mind, always take this with a pinch of salt, but we can see something to be said for the fact that this is probably the first company we have seen with a negative upside and such a large upside. Now, there will be people watching this who don't want to cherry pick any of these essential REITs or who don't want to have their hands in any REIT. They're more of an index fund investor or they want to develop in ETFs. What I would say is there is a investment or in fact an ETF for real estate. The VNQ is the ticker symbol. The expense ratio is pretty low, 0.12%, so that isn't the worst when you do compare it to others, essentially fees. And what we would say, essentially, when we take a look at their portfolio composition, what assets are held within here, we can see they are very well diversified. In fact, 9% is the data center REITs, which is one of their largest holdings, alongside industrials, and we also have retail REITs. More specifically, when we do take a look at the list of their holdings, we can see it is very well diversified, 7.6% in Prologis, AMT under 6%, Equinix under 5 or around 5%, CCI, SPG, lots of these REITs that we do talk about typically on a day-to-day basis. As always though, it does come down to what type of investor you are, so do let me know. If a lot of people do prefer ETFs, then I am happy to do a lot more content around ETFs, whether it's on real estate or whether semiconductors or others. But again, I do know a lot of people do like to cherry pick a look at certain companies, whether that is in the real estate investment area or whether it's just in any others as well. As always, let me know your thoughts in today's episode, whether you are buying any, whether you are selling any, and maybe whether or not you just prefer an ETF. As always, have a great day, see you on the next episode, and goodbye for now.